All right, welcome to the Explainer. You look at your stock portfolio, you see a list of company names. But have you ever wondered what's really going on under the hood? Well, today we're doing just that. We're giving a portfolio a full-on medical checkup, a Greek checkup to be precise. We're going to use some pretty advanced metrics to get past the logos and uncover the real story of its risks and its potential rewards.
So here's the game plan. We're going to start by breaking down the portfolio's core strategy, which is something called a barbell. Then we'll run the diagnostics using those Greeks I mentioned. After that, we'll meet the key players inside, the whales, the engines, and the cows. And finally, we'll get to the strategic bottom line, the action plan. Ready? Let's dive in.
So you might glance at a list of stocks and think, hey, that looks pretty diversified. But what story is it really telling you? What are the underlying conditions, the hidden risks and bets that you just can't see on the surface? That's what we're here to figure out.
And it turns out this isn't just some random collection of stocks. Nope. It's actually a very specific, high-conviction strategy. It's what's known as a barbell bet. And yeah, you can picture it just like a real barbell in the gym. Two heavy opposing forces on either end, creating this incredible tension right in the middle. So what exactly is this barbell strategy? Well, it's all about making a bet on two extremes at the same time. On one end, you've got your super stable, deep value assets. And on the complete opposite end, you've got these hyper-growth, really speculative plays. The whole idea is to get the best of both worlds, safety and explosive potential, by basically skipping everything in the middle. And this illustrates that split personality perfectly. I mean, look at this. On one side, you have the deep value end. We're talking public sector unit banks, think Bank of Baroda. They're stable, they pay dividends, and their PE ratio is super low, under 8. Then, on the other end, you've got the hypergrowth side, the really speculative stuff like Geo Financial and Adani Green. These things are volatile, and their PE ratios, through the roof, over 85. It's a tale of two completely different worlds in one portfolio.
Okay, so we've got this barbell set up, but the real question is, how does it actually behave, especially when things get rocky? To figure that out, we need to run those advanced diagnostics I was talking about, and that's where the Greeks of investing come in. These are special metrics that show us what the portfolio is truly sensitive to, and we're going to start with the first one, beta.
So what is beta? The easiest way to think about it is like a volume knob for the market, or maybe an amplifier. If your portfolio has a beta of exactly 1, it means it moves perfectly in sync with the overall market. But if your beta is higher than 1, you've turned up the volume. It's going to be more volatile, amplifying both the good days and, well, the bad days.
And guess what? This portfolio's beta is pretty high. We're estimating it's somewhere around 1.5 to 1.6. That hypergrowth end of the barbell is really cranking up the volume, making the whole portfolio act like it's leveraged to the market's every move.
So what does that actually mean in the real world? Well, it means that for every 1% the Nifty 50 index moves, this portfolio is basically engineered to move about 1.5% in the same direction. So let's play that out. If the market has a 10% correction, you need to be ready for a 15 or even 16% drop in your portfolio. This is absolutely not your average sleepy index fund. It is built for some serious swings.
Okay, so if beta is all about the risk you're taking on from the market, then our next Greek, alpha, is all about the reward. Specifically, it's the reward you get for being a smart stock picker. Alpha tells you if you're actually beating the market, if you're generating any extra return on top of what the market itself is giving you. But here's the problem. The very stocks that are supposed to be the growth engines, the ones that are meant to be delivering all that juicy alpha, we're talking about Geo Financial and Adani Green here, well, they've actually been sputtering. Over the last year, they've delivered negative returns. So instead of being a performance booster, they're actually a major drag.
All right, let's get a little more advanced. We're going to borrow two concepts that usually live in the world of options trading, but trust me, they have huge implications for this portfolio. The first is gamma. You can think of that as acceleration risk. And the second is theta, which is basically the hidden cost of waiting.
Now, this is so important to understand. The portfolio has high downside gamma. What that means is, in a real panic, when the market starts to drop hard, some of these stocks don't just drift down nicely. No way. They can gap down, meaning the price just disappears to a much lower level as all the buyers vanish. Your losses can accelerate way faster than the market index, and that creates a really dangerous trap.
And then there's theta, the cost of waiting. You've actually got a war going on inside this portfolio every single day. On one side, the cash cow banks are generating dividends, which is great. That's like positive theta. But on the other side, you're paying a massive opportunity cost by holding these super expensive, high PE stocks that are just sitting there, going nowhere. That's negative theta. And right now, the negative theta, that cost of waiting, is definitely winning.
So, who are the main players causing all these weird Greek readings? Well, the analysis actually breaks the portfolio down into 3 distinct characters. Each one has a very specific job to do.
First, you've got the whale. That's Geo Financial Services. It's just so massive, it acts like an anchor for the whole portfolio. Then you have the volatility engine, which is Adani Green Energy. This is the one really driving that high beta we talked about. And finally, you have the cash cow. These are the PSU banks, like Bank of Boroma, providing the steady cash and stability for the whole operation.
And as you can see here, each of these characters has its own job, but also its own unique risk. For the whale, the main risk is just concentration, having too many eggs in one basket. For the engine, the big one is interest rate sensitivity. You got to watch those bond yields. And for the cash cow, the worry is that we might be at a cyclical peak. Its best days could be behind it for a while.
Okay, so we've run the tests, we've done the checkup. So what's the doctor's final diagnosis? And more importantly, what's the treatment plan? Well, the analysis gives us a really clear 3-part action plan to deal with all the risks we've just found.
Step 1, hedge that downside. With that high downside gamma risk, you need some insurance against a sudden crash. Step 2, trim the deadweight beta. You need to take a hard look at those high beta stocks that are adding a ton of risk but aren't delivering any alpha. And step 3, watch the risk-free rate like a hawk. Interest rates are absolutely critical for your big energy and infrastructure bets. Their whole valuation depends on it. So when you put it all together, what's the bottom line? The diagnosis is pretty clear. This is a bull-run portfolio, through and through. It is designed to absolutely crush it when the market is roaring ahead. But, and this is a big but, it just doesn't have the defensive gear right now to handle a long grinding period of stagnation or a downturn. And maybe the most important takeaway is this. For this specific mix of assets, patience is expensive. That's a really powerful idea. Every single day that you're just waiting for those high-growth stocks to finally perform, that negative theta, that cost of waiting, is real. It's a tangible cost that is constantly bleeding value from your portfolio. So what this whole deconstruction shows is that every portfolio has a hidden story, a script that it's following under the surface. And that leaves us with one final thought, one question for you to think about. Does your portfolio have a hidden story? And more importantly, are you prepared for the plot twist?